Thank you, Greg, and welcome, David. And for those of you who are new to this conference, one of the additions is adding a perspective to each of our research panels from a practitioner. And in this case, we've been able to ask David Krause to join us, who is not only a community banking CEO, but who also is a practitioner of PPP lending. So, David, let's turn it over to you.
Very good. Thank you, Jim. First of all, I want to thank the Federal Reserve System, the Conference of State Bank Supervisors, the FDIC, for hosting this conference. I want to thank the moderator, Dr. Udell, for the great work you've done in your presentation. I want to congratulate the authors, Mr. Marsh, Ms. Sharma, Ms. Anvil, Mr. Carlson, Ms. Stasinski, for their work in the great research that they've provided. Your work demonstrates the several important factors, including the significant role community banks play in our economy, particularly in a time of anxiety and crisis, and then the value of the PPP and the PPPLF. The first slide shows you here some background on my bank. Pioneer Bank is chartered in Mapleton, Minnesota. We have 9 locations in South Central Minnesota. I like to tell folks we're a conglomerate, but what we are a collection of small community banks that came together via merger and acquisition. Our history spans 130 years. We have 130 employees, $730 million in assets. Our loan to deposit ratio at the most recent month end is 73%, and our highest industry concentration is agriculture, production, and farmland. The next slide. My role in the organization is that of the CEO. I've actually been with this organization for 35 years. I'm proud of that duration. I've been CEO since 2000. My background in banking is that of a residential mortgage lender and an ag and business banker. I grew up on the family farm in southwest Minnesota, Cottonwood County. I'm sure no one knows where that is. During my career, I've been lucky to be a part of 5 mergers and 1 de novo branch opening. And like every other community banker I know, I'm passionate about community development. The next slide will reflect on the liquidity that we had as our bank as we entered this pandemic. Prior to May of 2019, when we acquired the Nicollet County Bank in St. Peter, we were averaging about 95% loan to deposit ratio. And growing loans was really never much of a challenge for us. Growing core deposits always has been. And so some of the acquisitions I mentioned were a result of trying to create that liquidity. And the Nicollet County Bank was a $170 million community bank. They shared our philosophy. It was a natural extension of our geographic territory, but most importantly for us in liquidity, it had a 50% loan to deposit ratio. And some other tools that we had available to us from the liquidity side, we have an established borrowing capacity with the Federal Home Loan Bank in Des Moines. We did establish a line of credit, the Fed discount window, after the 2009 recession. However, we've never used it. And we also, after the recession, entered into a partnership and agreement with Promontory Financial Network, which is now called IntraFi, to offer reciprocal deposits. Many of our large depositors are entities such as cities, counties, school districts, and the ability to offer that program allowed us to retain those depository relationships. The next slide will show how our liquidity was impacted during the pandemic and how it impacted our participation in PPP. Our loan to deposit ratio at the beginning of the pandemic was 71.64%. It grew to 74% 13 months later when our PPP loan balances peaked. Our loan portfolio, and this is interesting, we were at about $401 million at the end of March of last year. 13 months later, our loan portfolio grew to $484 million. But during that period of time, our portfolio net of PPP loans actually dropped about $30 million. So that was a 7.5% drop in loan volume, when with the PPP, it was a 20% increase. Deposits during that same time grew as it did with most banks. We went from $560 million to $653 million. That's a 16.4% increase. The next slide will detail some of our PPP activity. In 2020, we made 749 loans. 540 of those were to existing customers, 209 were to new relationships. $68 million in total was advanced in 2020, $38 million to existing borrowers, $30 million to new. We impacted 6,900 jobs, and the fees generated by our participation in 2020, the fees to the bank, were $2.3 million. In 2021, the program was tweaked a little bit. It allowed more people to participate. It paid higher fees, and we ended up making more loans. We did 965 loans, 780 to existing customers, 185 to new borrowers, to us. $41 million in total proceeds. So you can see, even though we made more loans, the dollar amount that we advanced was lower. And we impacted fewer jobs this time, but still a significant number, 4,300. And we generated another $3 million in fees. So again, because the schedule switched, we were able to generate more fee income for the bank from the 2021 activity. The next slide reflects on how our market, the market that we work in, how that handled this. And there's some interesting things here, I think, and they're consistent with some of the detail that was brought out in research papers. We have branches in 3 counties in south central Minnesota: Blue Earth, Nicollet, and Watonwan. We did more PPP loans in each county than any other bank. The interesting thing about this is Blue Earth County is the largest and the most populated county of the 3, and we actually have the presence of 2 big banks in that particular county, Wells Fargo and U.S. Bank. And in terms of deposit market share, Wells Fargo has the most market share of any bank in Blue Earth County. U.S. Bank has the 3rd most deposit market share. Pioneer Bank, our bank, actually has the 5th highest market share. The PPP activity for those 2 banks was significant. U.S. Bank came in pretty close. Obviously, they did the 4th most PPP loans in that county, and they had the 3rd deposit market share. But Wells Fargo, the #1 deposit market share bank, didn't even crack the top 20 in the banks in Blue Earth County. So I thought that was particularly interesting. The next slide just reflects on some of the other programs that were out there during this time and kind of impacted not only PPP activity, but how we viewed that activity moving forward. Obviously, the stimulus payments that were coming to individuals, that helped grow our deposits and create liquidity for us. As borrowers took advantage of the PPP program, many of them also looked at how the SBA program, the EIDL program, could impact their business as well. And then we're a pretty active SBA lender, and the SBA guarantee loan benefits that came out of the CARES Act were also instrumental for the folks who not only use PPP loans, but as they were able to service their debt with us. We received $2.8 million directly from the SBA in payments made on SBA guaranteed loans during the prescribed period. That impacted 90 customers, 48 industries, and the average benefit was $31,000. So that was an interesting ancillary program to the PPP. The next slide, I share some of my reflections on the program. For us, outside liquidity sources weren't needed because of the increased deposits. Now, it would have been interesting how our bank would have handled this had we not made the acquisition of the Nicollet County Bank a year before the pandemic hit. If we'd have gone into this at a 95% loan-to-deposit ratio, our experience may have been completely different than it was. But the growth in deposits more than took care of the PPP lending activity that we did make. 23% of our PPP loans and 32% of the proceeds were made to customers of other banks, many of them big banks. And when we acted quickly at the beginning of the program, we were an experienced SBA lender. That certainly helped. We were drawn to the program because of what it could do for businesses that we thought could be vulnerable during an economic downturn caused by the pandemic. And then, but we also quickly realized how profitable this could be. And it seems silly, it really seems silly then, it even seems silly now that we were drawn to an opportunity to get a 1% return on the loans that we make. The investment alternatives weren't very good, and so the fees were huge, but even the 1% was significant for us because we were using money we already had. And then finally, we also, timing as it was, we had a CRA evaluation take place earlier this spring, and we found that during that exam, our participation in the PPP and the results we put up was instrumental in the outstanding CRA rating that we did receive this spring. So that was important too. And then finally, the last slide I have is a summary of some of the things that my observations of the research. The PPP provided important liquidity and eased anxiety during the pandemic. The liquidity it provided was for the businesses, and then in turn for us as well, because we benefited from the deposits. The PPP-LF availability provided assurance that bank liquidity could be devoted to the PPP, essentially served as that backstop if we needed it. Bank deposits grew because of PPP and the other stimulus programs we talked about, enabling us to make the PPP loans without using other liquidity facilities. And then finally, revenue generated by the PPP for banks, both the fees and the interest income, was essential during a time of significant loan activity contraction, and as was documented earlier, the contraction of net interest margin. So that's my reflection on the research papers and how it impacted our bank in southern Minnesota. I will turn it back to Jim. Thank you.